Tata Metaliks, remember that there was an initiating coverage by Elara Capital, and we'd like to talk to Tata Metaliks about the cost efficiency measures that the company has undertaken. How exactly is it going to lead to margin expansion? And also DI pipes, that's a segment that has been improving its revenue share in the overall revenue. So we're going to discuss that and much more with Mr. Sandeep Kumar. He is the MD of Tata Metaliks and he joins us right now. Mr. Kumar, thanks so much for joining us on ET. Now, you know, there's long been spoken about what sort of captive sourcing you have been working towards when it comes to your coke requirements, and especially with the vagaries and the input costs, it is something that's quite essential. So you produce about 40% of your own coke requirements, plus you have an agreement with Tata Steel as well for supply of the same. So currently, what percentage of your requirements are covered and how does it help in cost savings?
Yeah, so currently 40% is of course captive coke, and another 40% of our requirement is covered through long-term agreement with Tata Steel, which is actually linked to the cost of coal rather than the price of coke. So what happens is that you are exposed to the volatility only in the prices of coal and not to both coal and coke. So to that extent, by inking this agreement, a few months back, we have been able to gain from the fluctuations in the coke prices. So now almost 80% of coke is on long-term basis and 20% is left on spot to take advantages of prices just in case the spot prices are, advantageous to us. So that's where I think about 60 to 65% of our hot metal cost comes in.
Well, that strategy makes sense given how volatile commodity prices are. But coupled with sourcing, we are also seeing a drop in key raw materials like iron ore. So that as well works in your favor. Can we expect margins to expand?
See, I had already mentioned at the end of Q3 when the Supreme Court order had come that the prices of iron ore will go up, and because of the closure of some of the mines. And that led to an increase in production, that led to an increase in cost for us because of the increase in iron ore prices. But that's been the case for, I would say, almost everybody who buys iron ore. So we are no different. But what it did help was in maintaining or even increasing the margin, the spread between the raw material prices and the pig iron prices. So how exactly it would impact the margins of players would depend on to what extent they have been able to gain on the market side, but on the cost side certainly it would impact almost everybody who doesn't have a captive mine, and we are no different.
Okay. So that means, there is of course the higher domestic prices, there's no then that may in turn hit margins. Now you're already operating at close to 100% capacity. Any organic or even inorganic capex on the radar that you can tell us about?
Yeah, as I mentioned earlier that we are evaluating various options, both organic and inorganic, and we are in the, I would say, in quite an advanced stage, and we would be announcing this once we have our board approvals. Once the board approvals are in place. So over the next couple of months, I would expect to have more clarity, after which only I can communicate. But we are certainly evaluating all options, and we should have some clarity shortly.
Okay, fair enough, and I hope we can speak with you once you get clarity on the same as well. Given the capacity constraints, while of course you are working towards expansion via organic or even inorganic ways, it's going to be some time until that capacity actually does come on stream. So given capacity constraints, what would be the average volume growth you will be able to clock in going forward?
Yeah, so we have reached 100% capacity utilization, and any expansion, the impact of that can only come in, after a couple of years or so. So in FY19, I don't expect any major change in the capacity, but certainly by debottlenecking, we would want to do more than 100%, and we are already, in fact, if you look at our capacity utilization today, for the pipes plant, we are already more than 100%. So we would expect to do more than that. But nothing significant is going to happen unless and until we invest and into a major capacity expansion, and that's going to take some time, certainly not in FY19.
Okay, Mr. Kumar, just before we wrap up our conversation, you've been able to deliver stellar growth, albeit of course on a low base. So going forward, what will your average top line growth be, and also how will pricing contribute to the top line growth?
So we don't like to give guidance on how the future would be because it's dependent on a number of factors. But as of now, we seem to be on a good track. And typically if you look at the last few quarters or last couple of years, our EBITDA margins have been in the range of, say 14-15% for the pipe business, and for the pig iron business it's more like 9 to 10%. And we would expect to continue to be on this track of having similar if not more margins. And the effort right now in FY19 would be more on I would say cost efficiencies, more on initiatives like automation, so strengthening the core and put focus on automation, digitization, improvements of cost efficiencies, and hopefully if the market also supports, we should have a robust growth in FY19 as well. But at the moment I won't want to talk about it because our annual business plan for FY19 is still not through with the board approvals, etc. So once it is done, then maybe I can talk more about it after our Q4 results.
And Mr. Kumar, we look forward to talking about your Q4 results and even, of course, your expansion plans later as well. Thanks so much for joining us, and we wish you all the very best.